Welcome to Fireside Chat. My name is Sai. Let's talk about the 5 common mistakes people make with their Roth IRAs. I have seen a lot of these mistakes being made during the financial coaching sessions with my clients. I did the math the other day and I probably shouldn't have, but I did it anyway, and I'm going to show you this chart. I turned 18 in 2004 and I was already earning enough back then to maximize my IRA contributions, but I chose not to. And these here are the actual S&P 500 returns and the IRA contribution limits from 2004 to 2016. If I lump sum invested my Roth IRA up to the maximum contribution every year, even with these 3 down years, I would have had $102,000 in total return just in the Roth IRA. But because I didn't know how to properly budget and instead I got myself into $110,000 in consumer debt, I didn't start contributing to my Roth IRA until 2017 when I paid off my debt completely. So if I add $5,500 and $6,000 for these 5 years, my Roth IRA would have grown into $266,000 today. So try not to look back if you can. I was just doing this for fun, but now I feel like crying myself to sleep. Anyway, let's get into these 5 mistakes. And mistake number 1 is not contributing to your spousal Roth IRA. Did you know that you can contribute to a spousal IRA if you have a non-working spouse at home? And that's an extra $6,000 a year that people forget to contribute. The working spouse's income has to exceed the total IRA contributions made on behalf of both spouses. So for example, when you're filing taxes as married filing jointly, you have to make at least $12,000 a year in gross income or $14,000 a year if you're age 50 or older. Keep in mind that you cannot open joint accounts with IRA and your account is assigned per taxpayer. So one spouse will have one IRA and your non-working spouse will have another IRA. You can, however, both contribute from your joint checking account into the 2 separate Roth IRAs. You also have to file your taxes as a joint tax return or marry filing jointly. When you're both retired, you can share the withdrawals or distributions from both accounts together. You can also compete who made more money in their Roth IRAs. Just kidding, don't do that. Let's say you're both 30 years old and you contribute $12,000 into your 2 separate Roth IRA accounts. Each account with 10% average annual rate of return could turn into $2 million by the time you turn 60 years old. Keep in mind that these $2 million is in one of the Roth IRAs, so total combined is $4 million. So if you have a non-working spouse at home and that person doesn't have a Roth IRA open, I encourage you to open one today. When you're both contributing to a spousal IRA, it doesn't matter who funds the account. The named account owner of that spousal IRA will remain the same as long as that person lives. It is entirely up to your non-working spouse to make decisions on what to invest, how to make withdrawals, and how to designate beneficiaries. By the way, if you need help with your personal finances, you can schedule a free one-on-one 20-minute financial coaching session by visiting firesidechat.com/coaching. The number 2 common mistake people make with their Roth IRA is not designating their beneficiaries. This is especially important for people who are single or divorced. When you're married, if you leave the beneficiary blank, then it automatically goes to your spouse. But you have to think about the worst case scenario. What happens if you and your spouse both die in a car accident at the same time? I would recommend having contingent beneficiaries and reviewing the list of your beneficiaries on every financial account you own at least once a year. If you're divorced, your marital status doesn't get updated on your IRA. So if you haven't updated your beneficiary in a while, your ex-spouse might still be listed as the primary. You probably wouldn't want your ex-spouse to get your retirement money, right? Because remember that your retirement account beneficiary designation trump your will and trust directives. This is why we check our beneficiary designations once every year, because life always happens. My IRAs have both primary and contingent beneficiaries. Your contingent beneficiary is in case your primary beneficiary passed away at the time the benefit is to be paid. The worst case scenario is if both you and your spouse pass away at the same time. I would be careful with designating your minors to be the contingent beneficiary. If your child receives an inheritance from you, the child has to wait until 18 or 21 years old, depending on the state that you live in, to take full possession of the inheritance. Until then, the probate court will designate a guardian or that child's other parent to handle the inheritance. Most people wouldn't want the court to designate their ex-spouse to look after the money that they work hard for. I would arrange some sort of guardianship so that the probate judge would approve the appointment of that guardian to handle the money for your child. You can also set up a family trust so that you can designate a trustee to have more control over your money if you pass away. You can even designate your trust as the contingent beneficiary in your IRA. In your will, you can designate an adult custodian to manage inheritance under the Uniform Transfers to Minors Act or UTMA. Depending on the state that you live in, you can you can open a UTMA with a broker for your child. Whoever you designate as a custodian can make financial decisions in the child's best interest. So bottom line, check your beneficiaries at least once a year and make sure you trust that person to handle your money if you pass away. Mistake number 3 people make with their Roth IRA is not using a backdoor Roth IRA because they're above the income threshold. The IRS states that if you make over $144,000 a year as a single person or $214,000 a year as a married couple, you cannot directly contribute to the Roth IRA. However, there's a tax loophole to where you can convert your non-deductible traditional IRA contribution to the Roth IRA. This is also known as the Backdoor Roth IRA strategy. Basically, you need 2 IRAs to make the Backdoor Roth IRA happen, traditional IRA and a Roth IRA. My wife and I each have a traditional IRA and a Roth IRA accounts. We contribute directly to our traditional IRA as non-deductible contributions because we're above the traditional IRA income threshold. What we do is we hold it in the money market account inside the traditional IRA. Once the funding in the traditional IRA is settled, then I request a transfer from that money market account in my traditional IRA to a money market account in my Roth IRA. Let me give you an example. Let's say I can't directly contribute to my Roth IRA because we're above the $214,000 income threshold as a married couple. For the month of April, I'm contributing $500 to my Vanguard traditional IRA as a non-deductible contribution. I'm not going to invest that $500 in anything inside the traditional IRA. I need to wait a few days until the funding gets settled in the traditional IRA, and then I'm going to request a conversion or transfer of that $500 in my traditional IRA to a Roth IRA. When that $500 gets settled in the Roth IRA, then I can start investing and enjoy tax-free growth. You can also check out the detailed video I did on the Backdoor Roth IRA strategy, and I will put that video in the description below. By the way, you can get your free FIRE resources by visiting firesidechat.com/contact, and you can also check out the Fireside Chat shop, and I have all of my stuff on my bookshelf at firesidechat.com/shopping. The number 4 common mistake people make is forgetting to contribute to a Roth IRA because they already have a 401k. Guys, 401k is not the same as an IRA. An IRA is your individual retirement account that you own. A 401k is an employer-sponsored retirement account that your employer manages. If you're self-employed, then you would manage a solo 401k. In January 2021, Investment Company Institute published a journal that only 37% of US households own IRAs, and only 12% of US households contributed to a traditional or Roth IRAs in tax year 2019. You can absolutely own both 401k and IRA and contribute to both accounts at the same time. For the 401k, you can contribute up to $20,500 for the year 2022, and you can contribute up to $6,000 a year to either a traditional IRA, a Roth IRA, or contribute to both as long as it's not exceeding $6,000. The common question I get from my clients is why they need to have both when they can contribute more to the 401k and it's only $6,000 to an IRA. A Roth IRA allows you to grow your money tax-free, and not every 401k offers the Roth option, so I always recommend to contribute up to the 401k employer match and then maximize their IRAs up to $6,000 and then slowly contribute to their 401ks until they reach the maximum limit at $20,500. However, if you have the Roth option with your 401k, then you can do either or. You can maximize both Roth 401k and Roth IRA at a total of $26,500 for the year 2022. I also encourage everyone to open a traditional IRA and a Roth IRA today, even if you're not ready to make any contributions. There's a 5-year rule for Roth IRA withdrawals, so even if you're close to the retirement age at 59 and a half, you still have to have your Roth IRA open for at least 5 tax years after the first contribution you make to your Roth IRA. You also have to have your account open for 5 years when you make a direct rollover from a Roth 401k to a Roth IRA. You can watch the detailed video I did on the plan to withdraw $2.8 million when we retire early, and I will link that video in the description below. The number 5 common mistake people make with their Roth IRA is using it as an emergency fund. You can actually withdraw your Roth IRA contributions at any time without penalties. So for example, if you contributed $6,000 this year and you made $500 in earnings, you can withdraw $6,000 at any time without any penalties, but you will have to pay the penalty if you touch the earnings of $500. The money you contributed to your Roth IRA is already taxed, so the IRS can't tax you again. Your Roth IRA should be your very last resort, like a serious illness, a long-term unemployment, or other big emergencies after you have depleted your fully funded emergency fund in cash. However, I know some people who use Roth IRA as an emergency fund because their reason is they don't want to lose to inflation and the loss of investing opportunity in the stock market. But what happens when the stock market becomes volatile like we've been seeing right now in the short term? Your $6,000 contribution now becomes $5,500 or maybe even down to $5,000. You should always keep your emergency fund liquid and not invested in anything even if it loses to inflation, because you could lose a lot more to stocks, ETFs, or mutual funds in the short term during market volatility. You'll also lose many years of compound interest on the contribution you take out. The $6,000 you withdraw today is basically losing $126,000 in 30 years with 10% average annual return. You have to shift your mindset about how today's dollar could turn into $21 in 30 years. If you want to know more about how to build your first emergency fund and Roth IRA, you can check out these 2 videos. So with that said, I appreciate you watching my video. Don't forget to subscribe, and I hope to see you in the next video. Have a good one.